What if your reality was nothing more than a complex computer simulation? How would you know? What kind of technology could make the simulation possible? And how could you break out of the matrix?
The world of commodities trading is vast and complex. Traders use numerous financial instruments to buy, sell, and speculate on the prices of everything from oil and metals to agricultural products. Understanding these instruments is crucial for anyone looking to navigate this exciting field. In this video, we'll dive into the most commonly used financial instruments in commodities trading, exploring futures contracts, options on futures, spot contracts, exchange-traded funds, and more. By the end, you'll have a thorough understanding of how these tools work and their strategic applications in the market. Section 1. Futures Contracts. The most well-known instrument in commodities trading is the futures contract. A futures contract is a commitment to purchase or sell a specific good at a set price at a given moment. These contracts are standardized in quality, quantity, and delivery time, making them highly liquid and tradable. Traders use futures to hedge against price changes or speculate on price movements. For instance, a farmer might use futures agreements to fix the price of his harvest ahead of the harvest, protecting against a potential price decline when the crop is ready for sale. Section 2. Options on futures. Options on futures are another key financial instrument in commodity trading. These grant the holder the option to purchase or offer to sell a futures contract for a specific sum but not the responsibility to do so before the option expires. There are two types of options: calls, which give the right to buy, and puts, which provide the right to sell. Options are used for hedging and speculation but offer more flexibility than futures because they do not obligate the holder to complete the purchase or sale of the commodity. Section 3. Spot Contracts. Spot contracts involve purchasing or selling a commodity for immediate delivery, in contrast to futures contracts, which are settled at a later date. Prices in spot markets can be more volatile than futures prices because they are more directly influenced by supply and demand dynamics. Traders and companies that need immediate delivery of a commodity, such as a refinery needing crude oil, often use spot contracts. Section 4. ETFs and ETCs. For those looking to invest in commodities without directly trading physical assets, exchange-traded funds, ETFs, and exchange-traded commodities, ETCs, provide a viable alternative. These funds invest in commodities or commodity futures contracts and are traded on stock exchanges, much like shares. This makes them accessible to a broader range of investors, providing exposure to commodity prices without managing actual contracts. Some ETFs track a single commodity's performance, but others may invest in a basket of commodities to diversify their holdings. Section 5. Commodity Indexes. Commodity indexes are another vital instrument, providing benchmarks for the performance of commodity markets. These indexes track the prices of a basket of commodities, reflecting the sector's overall health and helping investors gauge market trends. For example, the Bloomberg Commodity Index includes 23 commodities from all commodity sectors and is a widely used benchmark. Section 6. Swaps. Swaps are complex financial agreements that future financial flows by a predetermined formula. In the commodities market, these often involve exchanging a fixed price for a commodity for a price agreed upon at the contract's inception. Companies typically use this. Companies usually use swaps to manage their exposure to price fluctuations in crucial commodities. Section 7. Master Limited Partnerships, MLPs. MLPs are an investment structure typically used by energy infrastructure firms in the United States. They combine a partnership's tax benefits with publicly traded securities liquidity. Investors in MLPs are paid regular distributions, much like dividends, and these investments are often used to generate income from commodities without needing to invest directly in physical assets. Conclusion. Each financial instrument has its characteristics, risks, and benefits, which suit different traders and strategies. Whether for hedging against future price changes, speculating on price movements, or investing in commodities markets, these tools provide a robust framework for engaging with the global commodities markets. Understanding how to use these instruments effectively is essential for anyone looking to succeed in commodities trading. Detailed exploration of futures contracts. Futures contracts are foundational instruments in the world of finance. They provide a structured marketplace for buyers and sellers to manage price risks or speculate on the future prices of various assets. These contracts range from commodities like oil, gold, and agricultural products to financial instruments such as currencies and indices. Their structured nature, with clearly defined terms regarding quantity, quality, and delivery date, makes them essential in global trading practices. They are traded on exchanges such as the Chicago Mercantile Exchange, CME, or Intercontinental Exchange, ICE, with margins and performance bonds providing security for both parties involved. Understanding options and their strategic use. Options are a versatile financial instrument used widely in the markets today. They provide traders and investors with flexibility, leverage, and hedging capabilities. Understanding how options work and how they can be strategically utilized is crucial for anyone looking to enhance their trading or investing strategy. There are two primary types of options: calls and puts. Buying options allows you to take advantage of price movements without the obligation to follow through, providing more flexibility than futures. Insights into swaps and their applications. Swaps are a financial derivative used widely in global markets to exchange cash flows or liabilities between two parties. These instruments allow companies, financial institutions, and investors to manage risk, speculate on changes in market conditions, or change their investment or debt profiles to support their financial objectives. Swaps are often used to hedge against risks associated with interest rate changes or foreign exchange fluctuations. Role of commodity index funds. Commodity index funds have emerged as a significant technique for investors wishing to spread their holdings beyond traditional stocks and bonds. These funds provide exposure to a wide range of goods, including valuable metals, energy supplies, and agricultural products. By tracking commodity indexes, investors can diversify their portfolios and hedge against inflation. Innovative financial products in commodity markets. In the ever-evolving landscape of global finance, commodity markets continually adapt and innovate. From commodity-linked ETFs and ETNs to the introduction of blockchain technology in commodity trading, new financial products help enhance market efficiency and create new opportunities for risk management. Innovations such as weather derivatives and smart contracts are also making a significant impact, providing new tools for investors to protect against market volatility. The world of commodities trading offers endless opportunities for those who understand its intricacies. By familiarizing yourself with these financial instruments, futures contracts, options, swaps, and innovative tools, you can navigate the complexities of the market with confidence. Thank you for watching, and we hope this video has deepened your understanding of commodities trading.